Thank you for joining us for our Seaspray Making Waves podcast series. Brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves Podcast.
Hello again, and a warm welcome back to episode 10 of the Seaspray Making Waves podcast series. And today we bring you our Q1 2025 investment review and outlook, packed with insights to help you navigate the months ahead. Just before we begin, a quick reminder that this podcast and the series are available now on Apple, Spotify, and YouTube, or you can listen to it directly from our website. You can also subscribe for free to our dedicated Seaspray Making Waves YouTube channel, and all of our broadcasts and research content is available from our LinkedIn pages for you to like and share with your networks. Also, don't miss our free weekly market review, which publishes every Monday morning, along with our full suite of market updates and our other financial video insights. And if you are searching for us online, it's best that you use the search term Seaspray Making Waves. That will make it easier and quicker for you to find us online. So for today's discussion, we're going to take a quick look back at the first quarter before we explore what lies ahead in terms of key challenges, opportunities, and everything really that investors need to keep an eye on. And there's certainly lots to unpack there. And joining me today to help make sense of it all, I'm delighted to say we're joined by our regular Seaspray contributors, Paul McGowan, Managing Director of Seaspray Financial, Danny O'Leary, Head of Seaspray Private.
Morning, Marty.
Welcome back,
Morning.
guys.
Morning.
Great to see you again.
Excellent.
So, not much has happened really since the start of the year, he says, with his tongue firmly in cheek. Yeah, for sure. And Danny, given all the volatility and uncertainty in markets, driven largely by the policy shift by the new US administration, the effect of all of that on global trade, and in particular on the four I's that we have discussed at length in our previous podcasts, our inflation, interest rates, income and investments, the impact on that, what's your view there?
Maybe before I just mention about what's going on in quarter one so far, Marty, 5 years ago, as we were sitting March 2020, there was no trade. We couldn't get out of our houses.
True.
We were prisoners because there was a pandemic that had hit the globe. So anything that we are talking about this morning, I just want to put it in a context that there's always going to be volatility. And one of the worst periods that we actually came through was quarter one in March 2020.
Very good point.
And I just want to highlight that because, yes, there's a lot of volatility going around, and we'll touch on all of that as we speak. But at the end of the day, we will come through it. And I think markets will look through that. And at the end of the day, it will create opportunities. And we might touch on some of those as we go through that. So I just wanted to put a context because it seems like every quarter, we had the Ukraine war in quarter one of 3 years ago. So there is going to be a lot of things happening on the geopolitical side as well as the market side. And back to now, it's very much three T's: Trump, tariffs, taxes. They're all really top of the agenda in terms of where we're looking at. And yes, that is causing uncertainty, and the markets do not like uncertainty. But again, our strong view from that is that whether you look at it half full or half empty, I'm seeing a situation where at the moment you're looking at MAGA, Make America Great Again. But I'm going to change that around. I think it's going to be MEGA. I think there's opportunity because I think it's going to be Make Europe Great Again. Because I'm seeing, we talked about this last year about Mario Draghi saying Europe has to invest, it has to get money. He was pushing 750 billion as a minimum amount that we had to get Europe to build infrastructure, to build in innovation, creativity, and within a matter of weeks, something I've never seen before is that in Germany, you now have a debt brake release of 1 trillion euros. And yes, it's defense, but it's also infrastructure. So the catalyst that I'm looking at is that, yes, we're going to have to deal with tariffs, and I think countries will get to grips with that. Yeah. But the critical thing is, does that create other catalysts for the countries to grow. And I think it's probably brought a more of a United States of Europe together, which was badly needed because we were so much lacking in terms of the gap between the United States and Europe.
Right. We've had a rotation, really, is what's happened. Now, what it actually does is it does open up great opportunity. Because as Danny was saying there, the US market had run very high. We did discuss how high multiples were, particularly on a core group of stocks. They've all come back down again. So this is a change. There's an opportunity now to go back and have a look at things that maybe we wouldn't have been as keen on 6 months ago because we thought they'd gone too far. Yeah. So yes, there's always worries on the markets, but we're interested in the global market. So sometimes one area isn't good and another area is good, and you have to be looking to make those switches. And that's what we can do here.
It's that balanced portfolio, maybe looking across some multi-asset classes,
Correct.
And that mantra that we've repeated before, that patience and time.
Absolutely. We have to look through this. And patience, it's so important because it throws up opportunities, and that's where we come in terms of looking to see where can we get the best value in the market. But it comes back to the 4 I's. You're absolutely, Marty, and I digressed away from it. But in the recent times, we have seen the uncertainty impacting the Fed. Recently didn't do anything on interest rates because, again, they're just not happy that the uncertainty in terms of the impact of trades and that on tariffs on trade could be inflationary. So they're being cautious. We still expect 2 rate cuts, Paul, I think.
In the US,
I think
between now and the year end.
Right.
Yes.
Now, Europe, there's a sort of a view that they're, with inflation under control to a certain degree, we're around about 2%.
Yeah.
We are looking at interest rates moving in a downward direction. I think another 2 cuts there, probably in relation to where we see European. That's positive in terms of supporting valuations for equities as well. But if inflation is more or less under control in those major economies, the US inflation is about 2.8 at the moment. So it's still a worry, but it's nothing dramatic at the moment. I think the good thing is that the central banks will act if they are seeing warning signs in terms of the economy. But they do acknowledge that tariffs, I think Powell came out in the recent speech to say growth in the US probably around 1.7 instead of 2.1 in terms of the current year. So I think they're being very cautious, and I think that's the way they need to be acting as we go through 2025, given the uncertainty. But the one standout is that I look at Q4 earnings. Q4 earnings is in double digits from the United States and high single digits for Europe. So the valuations that you and I speak about in terms of the multiples are not demanding when we're looking at value in the markets throughout 2025.
Fundamentals.
So I think the fundamentals are still reasonably intact.
Strong, And you mentioned tech stocks. I mean, we had that bull run for the last couple of years, and the Mag 7 or the Lag 7 that I heard referred to recently. It's but I take it we're still positive on AI and technology stocks going forward.
Hugely, the world is in a major change. We are at the stage like we were when the internet started. We're only at the start of the positive implications of what AI can do to businesses. The adoption of AI into businesses is going to grow at a pace. There was an issue with regard to some of the companies in the sector had a build-up in inventories. Those inventories have now been taken out. So there's going to be a strong demand back into that sector. And I think you'll see in the next quarter, again, a return back into tech stocks, because that's the fundamental to how you get production, how you get value, how you make money is going to be in some of these stocks. And across, there's also, it's broadening out. We talked about it before. There are whole sectors that support the tech sector. So the big thing with AI is going to be able to have your cloud storage, your data storage. I just heard recently that there's a new storage, data storage in the States that's being built in Texas that's the size of Manhattan. Now, just to put it in context, these data storage centers are going to be enormous because the computing power required to use the AI is enormous.
Right. And
that
the most
has
important
a drive.
thing on that, Paul, is it's driven by renewable solar energy
Absolutely.
as well. So
Absolutely.
I again, coming back to that point, I think we are very much on the toes. I know from a European perspective, certainly from the Commission, there's probably going to be an investment of in excess of 200 billion into AI over the next while. In America, it's going to be colossal as well. And we would be firmly as a theme looking at current valuations from the tech. Apple, Microsoft, NVIDIA, they're coming back to valuations that are reasonable.
Yeah.
They have been expensive, but the earnings have been, responding accordingly to those valuations. So the valuations have come back over the last while. Is it a correction? I'd probably say it is in relation to, is it an opportunity now that we can actually look at them in terms of the next 2, 3, 4 years in terms of part of portfolios. But I do believe that the rotation that we've seen, there are 7 stocks. There are 493. So stock rotation is very important as well to have that balance. So if the overriding scenario is that with the correction that we've seen from tech at the moment, I think that's an opportunity, by the way. I really do in terms of AI. And I think at current valuations, we're looking at that certainly as an area as we go forward.
Yeah, because when you say about rotation, it spreads out. The whole industrial area, particularly in, let's take the S&P, you've the power energy companies, the gas turbine companies, all these companies that have produced power are in the industrial sector. They're not perceived as tech stocks, but they're going to see huge demand. There's talk of $300 billion plus spend over the next 12 months on some of these areas. And that's going to help drive markets. There was recent, in the States, there's been quite a few tech conferences, and the feedback coming out is that spending is increasing, not falling. Right. And the likes of Meta, Google, Microsoft, Siemens Energy are all seeing really strong demand for their products. And therefore, that's going to help drive. We're going to see a drive on in markets.
Well, that's so. What I'm hearing is, stay calm and carry on. I mean, it's calm heads and looking at the opportunity.
Absolutely. We have to remember that the Magnificent Seven probably in over 2 years delivered over 150%. Yeah. You've got to put context again in terms of if they're down 7 to 15%, over the last while. Tesla is an outlier to that. There are specifics happening because of Tesla, as we all know. But the critical thing on the core 6 out of the 7 is that, AI and the tech story is not going to go away. It's going to be with us over the next number of years.
Absolutely. And as we've always said, it's not time in getting into the market, it's time in the market. Yeah. And we look at long-term investing, and if you're investing for the long term, then you're going to have lumps and bumps like this. Our data insights that we produce on a regular basis, the most recent one shows just the performance of markets over since 2007. And all the hiccups, yet when you look at the charts in that study, you can see a positive move over a 10, 15-year period. Yeah. Even though we've had big dips and we've had all sorts of issues have happened, overall the markets are up. So being invested for the long term is key.
Well, thanks for reminding me, Paul, because we do have our suite of video insights. We're talking about a diversified portfolio. There's one in particular, which is the case for diversification, is worth checking out, I think. So that's available for free to watch on the website. And that includes the other
asset classes. I think bonds are a part of that as well. Yeah. And I think with interest rates still on the downward trajectory, I do think they are part of that multi-asset type approach for many of our clients that would have multi-asset portfolios.
Absolutely,
without a doubt.
Yeah. I'm going to bring the spotlight back as we tend to do on the podcast back domestically. So all of this is obviously going to play on the Irish economy. And Paul, what are the potential headwinds for Ireland, given the likelihood of a trade war developing between Europe and the US in particular?
Oh, okay. So in recent weeks, the ESRI have come out with their latest report. And what they're saying is that they think the GDP of Ireland is going to grow by about 2.8% this year, taking account of forecasted tariffs. And we're still, they're on, they're off problem. They estimate that it'll have an impact that will take the following year, the economy will grow by about 2.1%. We're still talking positive growth.
Right.
We're still developing. The pharmaceutical companies will have to adjust. The other areas are obviously in the areas of alcohol. So some of our the whiskey producers and people, they're going to see some hits. But people will adjust. And we have no certainty that these tariffs are going to stay in place.
Yes.
They could very quickly adjust because the approach seems to be lob in a bomb and let's negotiate then afterwards. And so in 6 months' time, we could be talking about a whole different scenario. As an economy, our economy, we're at almost full employment. We have, we're exporting 72 billion of goods to the US at the moment, of which 58 billion are pharmaceuticals. So yes, that's a negative.
Yeah.
But we have a lot of other things going on, other export areas that will benefit. The government is aware of the situation in terms of what's happening. There's a lot of meetings going on in terms to see how do we protect the economy here. Luckily, we've built up reserves, so we do have that capacity to protect ourselves. But it really, when you don't know what's going to happen next, it's very hard to project. So all that people can do is just get on with their business as is.
Yeah, very true.
I think what we're looking at probably is the companies that are here are not going to leave. Like if you've got your European headquarter here, it's called your European headquarters, so you can target Europe. We are the only English-speaking country in the EU. So all of that remains. We still have a very attractive tax structure for businesses to remain here. So I think the businesses that are here are going to remain and going to continue to develop. The question will be over the next 6 months whether or not we'll see as many new businesses coming in, because I think that there will be an element of just need to have to think about where am I going to put myself. But people will take those investment decisions and then move on.
Yeah.
And then there will be companies that will say, okay, well, do you know what? I'll open an operation in the States and now I'll go and do another one in Europe, and I'll do and all of the reasons for why they're here at the moment continue to be the same.
Yeah,
agreed.
So I think nervousness, yes, but when you look at the state of our economy and look at how things are, I think the overall backdrop is still going to be very positive. The ISAC, as you mentioned, is already having a very strong run. We have some very good companies listed on the markets, and there's some very interesting opportunities in those for investors. So I would be on the, be calm and see where this goes.
It's very much a case of watch this space, which is an expression we're using a lot these days.
Wait and see, and most companies have done scenario planning. I mean, we have to go back to 2016 when we had Trump at the first time coming in. So this is not new in regard to,
exactly. Yeah.
Wow, we have companies that have been for the last number of months scenario planning, and governments, and among them our own and the EU. And again, on the pharma sector, a lot of the product is not finished product. A lot of that product still goes back to to the States to be finished and finalized in the States. So my view here is that it's a case of wait and see in terms of what eventually comes out. But we have seen already. You have a tariff one day and it might come off the next day. So I think it's creating a lot of uncertainty, and I think it'll be a case of let's see how that pans out over the next number of months.
You mentioned Lanigan's ball earlier, Danny. I think that's pretty true. Just on our last podcast, our 2025 outlook, Danny, you highlighted sustainability and AI as key investment themes to watch for the year. I mean, given our own in-house experience with the successful maturities on our structured product, particularly in the sustainability area, I take it that's still a strong growth theme for 2025. Yeah?
It's more than ever. I have to say that while we are in challenging times, particularly from the United States in terms of sustainability, it's not going to roll back. The globe and the planet and climate and ESG is not going to go away. It's and we're seeing this even in the United States in terms of some of the renewable projects. And there's a lot of good renewables work going on in the United States, despite what we're seeing and hearing in terms of the news. So our strong view is, and just to let you, we had a green global structure that matured in this quarter.
Yeah.
It went for about 3.5 years and it produced 35%. So that's a green glow. And it's done what it said. We have a climate change that's coming out as well, and a water bond that has actually matured. So they are all themes that are still very much at the forefront of what many believe is something that we will be focusing on for the next 10 decades as we go forward to protect the planet. So the critical thing is that, and I'll give you an example. a very big UK pension fund, UK People's Pension Fund. It's a multi-employer pension fund. Recently took away $28 billion dollars from a US fund manager, State Street, because they had rolled back on ESG sustainability principles.
Yeah.
Now, they put that money with two different, a bond manager and an investment manager, which are very focused in terms of the sustainable issues, Amundi and Invesco. That is a very telling scenario that, people across the globe, they are very much in the sustainability area. And I think that has a major ramification in terms of where people are turning against sustainability. So our focus, just to reinforce, is that we will be looking at value, we'll be looking at ESG, we'll be looking at climate change, we'll be looking at where do we see value in terms of companies who are doing the right thing for the planet. And I think they will be rewarded over the next decade.
Strong message, Danny.
And I just, to reinforce that, the structured notes that we produce are, all we need is the markets to stand still.
True.
We don't need the markets to run ahead. And yet, as long as they stand still over a 2 to 3 year period, the investors are making extremely strong returns in these positive sectors. So it's a lovely investment hedge for clients to have in their portfolios.
Definitely. That's an excellent point, Paul. Yeah. Now we'll come to the point in our discussion about questions from our clients. I know you always enjoy this part. So, Paul, I'll come to you first. One client is asking, are there less volatile stocks I should consider investing in as world trade adjusts to tariffs and all the geopolitical uncertainty?
Interesting question. Equities are always going to be affected by the markets.
Yeah.
So less volatile stocks, well, then you'll look towards utilities. We would historically have said pharmaceuticals. We're just a little bit uncertain at the moment in those areas. But there is a theme of quality stocks within, let's take the Irish market that you can go for. We have consistently been fans of Ryanair, biggest airline in Europe, still have a strong feel towards it. We expect its share price to move towards 25 euros over the course of the next 12 to 18 months. So, you have a sort of a 20% potential upside from where it is. You can also go and look at some of the broader areas in terms of markets. So again, we've had a big pullback in some of the tech stocks in the States. You can call it volatile, but these companies are enormous. And with that pullback, it opens up some really interesting buying opportunities. So I would, again, for clients, be looking back into those sectors as areas to buy into. The
other key factor I think there would be also for clients that may be a little bit cautious, the multi-asset approach, rather than maybe coming out of less volatile equities. Equities are going to be volatile, right? But you can actually temper that by probably bringing in some bonds into the portfolio or some, alternatives into the portfolio. So there's different ways that you can actually balance to take risk off the table.
Just hold your powder dry there, Danny, for a second, because the second question,
we got another one.
It is. You've jumped the gun there, but anyway, the second question is, given the trade uncertainty and lower interest rates, is commercial property or other asset classes, for that matter, worthy of consideration in a more diversified portfolio? So
again, I'll always come back to the fact that we strongly believe equities over the long term will deliver. But you have to sleep at night, and you have to be able to take the risk that you're comfortable to live with over the whatever time period that we can look at. Yeah. So in dealing with that, all I will say on a client-by-client basis, what we have to look at is what are the comfort zones, and if we're not in the sort of a higher end, we bring it and we tailor it back to be specific, to be able to say we have enough of other asset classes, and that will include bonds. It will include maybe a little bit of property as well, alternatives. I know we had one question last time about commodities, etc. Gold has done very well over the last couple of years. It's probably up 15% year to date so far. Would I have loads of gold in the portfolio? No, but I have maybe some as part of that balancing of the overall scenario. I had one client asking me about copper.
Right. In the news,
and copper, certainly, when we're looking at AI and the use of copper as a metal, certainly. But at the moment, then you could have a tariff slapped on it. It is speculative in that type of nature. But again, we can temper that as part of the overall balancing of the portfolio, Marty. Okay. But I always come back. This is client on a client by client basis, looking at your tolerance for risk. And we will always say you have to sleep at night in terms of the decision making. And I'll come back to it. Patience over the medium to long term. Never, when it's volatile, you stand back.
Yeah. I'm sorry, just one other area. Paul. Like when you are looking at the moment, you were saying what could be interesting. An interesting area to look at could be US defense stocks.
Yes.
Which actually went through a bit of a rough patch there because the view that America was going to pull out of being involved in global scenarios. The flip of it is that Europe doesn't have the capacity to meet this investment that is going to be made in defense. So the most likely scenario is that we're going to end up they're going to be buying product from US defense companies. So that sector is a sector that's probably worth looking at as well. Just, if people are looking at things.
That's excellent. That's some great insight there for our clients on their questions. Guys, unfortunately, the clock has caught up with us again. It's amazing how fast the time goes. So I just thank you very much for your insight. I think you've enabled our audience to look beyond the uncertainty today and at opportunity, I think, which is great. So brilliant. Thanks very much.
Lovely. Thanks, Marty. Thanks.
So to read more detail on today's discussion with Danny and Paul, you can now download for free our Q1 2025 investment review and outlook direct from our website. From our LinkedIn content, along with our full suite of market updates and our financial video insights, which are also available for free to download from the site and from LinkedIn. As I said earlier, don't forget that if you are searching for us, use the term Seaspray Making Waves. That'll make it easier for you to find our content online and quicker. So in conclusion, just a quick reminder that this podcast and the series are available now on Apple, Spotify, and YouTube. You can listen to it directly from our website. You can also subscribe for free to our dedicated Seaspray Making Waves YouTube channel. So to wrap up, thanks very much for watching today. We'll see you next time, and bye for now.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives, and may not be suitable for you. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. Thank you.